Welcome to Flippening, the first and original podcast for full-time, professional, and institutional crypto investors. I'm your host, Clay Collins. Each week we discuss the cryptocurrency economy, new investment strategies for maximizing returns, and stories from the front lines of financial disruption. Go to flippening.com to join our newsletter for cryptocurrency investors and find out just why this podcast is called Flippening.
Clay Collins is the CEO of Nomics. All opinions expressed by Clay and podcast guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions.
Hey, this is Clay, and before we get started with what's become one of my favorite episodes to date, I wanted to invite anyone who's listening to this who's passionate about crypto asset market data to reach out to me on our contact form. My company, Nomics, has a crypto asset market API product and will soon be releasing some new features that we'd love to get your feedback on. If you're a developer, analyst, or fund manager that relies heavily on trade and order book data from exchanges, please contact me by going to nomics.com, navigating to the Contact Us form, and dropping me a line. You can also find me on our Telegram group if that's easier at nomicstelegram.com. Finally, if you want to use what is hands down the best crypto asset market data API available right now, go to nomicsapi.com. The API is 100% free and has no rate limits. Today's conversation isn't quite a documentary, but it also isn't your average interview. So I'm labeling this a deep dive, and the topic is programmable peer-to-peer tokenized debt. The Flippening Podcast, this podcast, is first and foremost for institutional investors, and I'm covering this topic because the dual issues of debt and lending are just too big to ignore and absolutely rife with investment opportunities, many of which we talk about during this conversation. While there's been a lot of talk in the blockchain space about tokenized stores of value like cash, as well as tokenized securities and commodities, the topic of tokenized debt has received such little coverage. This is unfortunate because worldwide debt markets are actually larger than stock markets and much, much larger than money supplies. I'll use the example of the United States to illustrate. Here goes. The M2 money supply in the United States is 13.5 trillion. As a side note, M2 money supply includes not only liquid forms of money like cash, coins, and checking accounts, but also less liquid forms of value such as savings deposits, money mutual funds, and other time deposits not easily transferable to physical money. Okay, so we've got the US M2 money supply at $13.5 trillion. By contrast, the size of the United States stock market right now is about 30 trillion, so over double the size. But guess what's even bigger than the $30 trillion stock market? Well, the United States bond market is bigger, with over 40 billion in debts outstanding. And that's just debt represented by the bond market. It doesn't even include household debt and other forms of debt. So to summarize, we have U.S. money supply at $13.5 trillion, the stock market at $30 trillion, and the bond market at $40 trillion. So yeah, debt and debt markets are a huge, huge deal. Furthermore, when we put our anthropologist and historian hats on, we find it very likely that humans issued credit and debt long before we adopted currency or coinage. Debt came before money. My co-creator for this content is Nadav Hollander, who is the founder and CEO of Dharma, a platform for building borderless lending products using programmable tokenized debt. And incidentally, Dharma does not have a token, so he's not here to shill his coin or pump his market cap. We spend about half of our time talking about debt, its history, the nature of debt markets, and peer-to-peer lending with Web 2.0 technologies on platforms like Lending Club and Prosper. The second half of this conversation is about the Dharma protocol itself, how it works, use cases, and opportunities for entrepreneurs and developers around the protocol and platform. We start this deep dive by learning a little bit about Nadav and the origin story of the Dharma protocol. The rest of this deep dive is broken into 5 chapters. In the first chapter, we discuss the history and origins of debt from the origin of the human species up until around the year 2000. In the second chapter, we discuss the history and development of blockchain technologies that have paved the way for programmable tokenized debt and the Dharma protocol. In chapter 3, we discuss how the Dharma protocol works and the first-class operators within the system. Chapter 4 focuses on the top use cases and investment opportunities for tokenized debt. This chapter is of particular interest for investors that are looking to generate a return on this space. In the 5th chapter, we discuss Dharma as a corporate entity, how it works, where it operates, etc. I should mention that this podcast is made possible by Rex BKC ETF. BKC is managed by Brian Kelly, a cryptocurrency and blockchain professional, CNBC contributor, Bitcoin author, and BK2Cents blog author. Equity can add a different dimension to cryptocurrency investing. Just as gold miners needed pans and wash plants, cryptocurrency needs hardware, software, miners, and exchanges. Brian finds the companies trying to profit from the building of crypto infrastructure and puts them all in one fund, BKC. Please visit rexshares.com for more information on the ETF and to sign up for Brian Kelly's blog, BK2Cents. Now, here's the legal wording. Investors should carefully consider the fund's investment objectives, risk factors, including cryptocurrency and blockchain technology risk, charges, and expenses before investing. This and other information can be found in the fund's prospectus at rexshares.com/BKC. Read it carefully before investing. BKC is not suitable for all investors. Not all companies BKC invests in may have significant exposure to blockchain or cryptocurrency, although it is the focus of the fund. The advisor's judgments may be wrong and lead to loss of principal. Distributed by Foresight Fund Services, LLC. Again, for more information, that's rexshares.com. Nadav, can you tell us about the origin story of the Dharma protocol and your founding of the project?
Sure. So first of all, just as a little bit of context, what Dharma is a protocol for borrowing and lending crypto assets on blockchains. Our basic core thesis is that there are a whole litany of interesting financial services that can be built on blockchains that we believe are going to be fundamentally more globally accessible and transparent and fair. But those are probably a little bit of a ways out, and all of them sort of lie downstream of having a robust decentralized credit market in general. And so what Dharma is building is essentially kind of the infrastructure for a decentralized credit market in which anybody in the world can engage in sort of like a peer-to-peer debt agreement that is entirely mediated by a smart contract. So that's Dharma, but it didn't necessarily start that way. I started thinking about essentially this concept back when I was an engineer at Coinbase in 2016. And this was particularly a time in which Coinbase had started sort of really putting its weight behind Ethereum and the community around it. And it was really exciting because a lot of people were working on interesting projects that were basically like, let's create prediction markets, but decentralized, or let's create DNS, but decentralized. And so my kind of kernel of an idea that I was interested in was creating basically like Lending Club, but decentralized. And I ended up tinkering with that for like 6 months, playing around with a lot of different models for it, trying to learn as much as I can about kind of where people had failed in going down similar paths in the past, and eventually left Coinbase and graduated school as well, and ended up getting into Y Combinator and starting to work on this idea.
What's the intellectual underpinnings of your journey, and how did you get here? Did you study economics in the past? Have you always been involved in debt markets? Did you play around with Lending Club and prosper in those types of platforms in the past, maybe taken out a loan or given one, or, the average person just doesn't get up someday and say, I think we can reinvent global debt markets. What was your personal journey?
I'd be lying if I said that I had some sort of formal background or training in debt capital markets. And I think it's also important to note that the way that Dharma started off was much more narrowly scoped than what it is right now. In that I'd admit that when I started working on Dharma, it was very much naively concepted as we want to have peer-to-peer microloans that anybody in the world can take out. The basic kind of archetypal image that I wanted to make come true was anybody in the world that has an internet connection can go out and take a loan online, which right now isn't necessarily the case, right? It's not like you can if you're in Karnataka, India or something like that, it's not like you can go on lendingclub.com and take out a loan. And so I was very much at the time thinking of it from the perspective of narrowly, how can you do things like Lending Club, i.e. peer-to-peer consumer lending, from the perspective of in a decentralized manner, that is borderless and globally accessible. And in that process, that's very much something that led me to have to learn a lot about how lending businesses work, on how peer-to-peer lending businesses in particular have kind of panned out over the past, 10 years or so. And in the process, I got exposed to a lot of what is sort of the like Rube Goldberg machinery that underlies the financial system. And I can't necessarily say that I was like seasoned in like the battlefields of Wall Street per se, but I think that in having hashed out a lot of different models for how this protocol could work and actually built out various kind of first iterations of it, I think I earned some of my stripes in terms of learning how this kind of machinery works right now.
Okay, let's kick off chapter 1. In chapter 1, we're going to put on our historian hats and attempt to contextually place programmable tokenized debt and what Dharma is doing. We do this by exploring debt from the origin of the human species up until around the year 2000. We also explore Web 2.0 peer-to-peer lending platforms such as Lending Club and Prosper. So, Nadav, can you speak to the historic and macroeconomic forces that take us up to the year 2000 and the birth of peer-to-peer lending on the internet?
I can try to give you a crude summary of probably one of the better treatises on this. There's this book called Debt, the First 5,000 Years. It was written by a guy named David Graeber. Basically, kind of the core thesis of this book is that people have this conception of how money and loans kind of like came about. And it usually goes something like this. The theory is like, in some British village somewhere, I was trying to like trade my goat for something and somebody else had a bunch of shoes. And we had this issue because like I don't want the person's shoes and he doesn't want my goat, but we both want to get rid of like our items in some capacity and liquidate it. And so, they call this the so-called double coincidence of wants problem. And the theory goes that essentially this is how money came about. It was the bridge asset for everything, right? And David Graeber's really interesting argument that he makes is that actually, in a weird way, people were kind of essentially like keeping credit tabs on one another well before they were actually using like hard currency to purchase things. So you can imagine it being like, if you lived in a village and there was some sort of informal social system in which like people knew at a certain shop that you were owed a certain amount of money by one tradesman and you were owed a certain amount of money by another tradesman and you yourself owed a certain amount of money to another person. And all of that stuff was kind of tracked very informally. And the argument that David Graeber makes is essentially that this predates money and in many ways actually created money. And that like money was the instrument that was used to eventually settle these different debts and accounts. And so it's really interesting because you can kind of go back, and this is exactly what his book does, and you can kind of go back through history and see that like there's just like so many historical debt accounting systems that almost predate money in many cases. And that additionally, like so much of the way that we talk about things in the world, like so much of our language is actually embedded with terms that have to do with like debts in general. And especially like when it comes to like morality, a lot of the ways that we talk about like morality is spoken in terms of debts. Like for instance, you have a debt to your parents for having like birthed you. It's kind of like honor thy father sort of things. So basically, long story short, I'm giving you a crude summary of this extremely long novel right now. But the point is that pretty much as long as humans have been around, like we've been keeping tabs on who owes who what and framing kind of a lot of like our social ranking in terms of debts as well and framing our society around them. And what's kind of fascinating is that what had happened in kind of the invention of the financial system, call it, let's just say the modern financial system started in 1800s, which is, you can make an argument that's more like the 1600s, but let's just say for sake of argument right now is like the 1800s or so. Modern financial system starts to get developed and all of a sudden things like the telegraph come around and people have the means to communicate globally at a speed that they never had the ability to do prior. And you have kind of this creation or like this parallel emergence of a formalized financial system where people are not necessarily just kind of like informally keeping tabs of debts with one another, but rather are using legal contracts to like encode, this person owes this much money to that person, or rather like this country owes this much money to this bank. And arguably, a lot of kind of the development that came in the 1800s and 1900s had been financed by this kind of emerging financial system. The most notable example being like the railroads, right? This is what made the JP Morgans of the world so powerful, is that they basically financed the railroad boom. And so essentially like the modern financial system emerged in the 1800s, 1900s or so, and basically like became kind of the engine of growth behind like America and also like the world at large in many senses. And, you'd ask me to kind of stop before 2000. So I'll pause there, but I think 2000 is where things kind of take an interesting turn, in particular with respect to the financial crisis.
I guess I was thinking about around 2003, we start seeing a bit of peer-to-peer lending activity. It sounds like you have some thoughts about the role of the financial crisis and some events that catalyzed.
Yeah, absolutely. A lot of people would argue that the quote-unquote success of the early peer-to-peer lending platforms was almost entirely catalyzed by the fact that the financial crisis came about, right? In that, like, all of a sudden, it was like much, much harder for a lot of people to get loans from traditional banks. And so there was a really compelling argument to be made that creating a platform where you didn't have to tap into kind of the traditional financial system to get a loan was very, very compelling and could, open up credit to a lot of people who at the time were hurting. Now, that kind of rosy picture of like, we're going to dismantle the financial system and we're going to kind of use the internet to now let people lend directly to one another. That rosy picture isn't exactly how things played out, right? It turns out that, when you look at companies like Lending Club and Prosper and literally thousands of these companies nowadays, when you look at these companies, they're largely kind of just like Web 2.0 storefronts for the existing financial system. Lending Club being a great example. Insofar as like, I may be misstating the percentages here, but something like 80% of the loan volume on Lending Club is institutional. It's literally just like hedge funds cutting, these large like debt facilities or, these debt funds essentially, basically like underwriting these loans in a way that basically leaves like the bottom tier of all the loans for retail investors. And mind you, like on the back end, these companies are largely operating at the same sort of technical fidelity that most banks are as well. It's basically all Excel behind the glitz and glamour. So what you kind of saw is that like rather than these platforms really actually like changing the fundamental fabric of how lending worked in the modern financial system, rather they kind of just became sort of like a cosmetic facelift.
What problems remain to be solved, bringing us to the origin of Dharma with systems like Prosper and Lending Club? Who was sort of left out of that system, and what were the biggest problems that they needed solved?
To answer that question, I kind of like to look at the way the internet has influenced the development of technologies in general, or rather how it's influenced the development of different sectors of business. If you look at, for instance, like content is a great example of a industry that was just absolutely totally transformed and, in my opinion, for the better by the advent of the internet. And the way that kind of happened is pretty simple, right? It's like previously the distribution of content was like a relatively expensive thing, right? Like you needed to have television rights. You needed to have like a physical distribution mechanism for things like newspapers. And that generally created barriers of entry that in general just made content a less competitive industry.
Before we get too much into the problems that existed with these initial kind of Web 2.0 peer-to-peer lending solutions, let's walk through what the experience is for someone using one of these platforms. My understanding of how it works is someone signs up for one of these systems, they describe the kind of loan that they're looking for, and they say something about what they're going to use it for. They fill out a profile, maybe employment status, there's a credit check involved, and then someone is on the other side of that vets them according to whatever criteria they have and will offer them the loan. What else is involved with those platforms?
In theory, yes, right? But there's actually like a whole rigmarole that happens behind the scenes to enable this to happen in a legal way, right? The biggest factor that needs to be taken into account is that there are super heterogeneous banking and lending regulations across the United States in different states in America. And like if you are a company based in Silicon Valley and you want to issue loans to potentially anyone in the 50 states, basically the best way to do that is to be a bank, right? To be a chartered bank, because chartered banks, at least in certain states, have these things called blue sky laws. I don't think I need to get too much into the specifics here, but the point is that like from a regulatory perspective, these things become like infinitely easier when you're actually a bank. And so this funny thing kind of developed around peer-to-peer lending, where essentially what happens actually behind the scenes is that there is a bank that is issuing a loan at the end of the day on a peer-to-peer lending platform. You're not actually taking a loan out directly from the peer on the other side. What ends up happening is like a bank usually it's in like a place like Utah, is going to like issue you like a paper loan. That loan is going to get bought by Lending Club. And then that like loan is going to get fractionalized and sold to the other side of the market. And so what you really have at the end of the day is something that is several steps removed from like a true peer-to-peer transaction. And that, at least the argument that I would make is that it's the quote unquote peer-to-peer aspect of it becomes much more of a marketing play than it is actually an instrument of adding efficiency to the system.
It's just kind of a egalitarian seeming wrapper around a very old and traditional and regulated system. With this peer-to-peer system, who's left out and what problems are yet to be solved with these traditional peer-to-peer systems?
There's a couple caveats here. I actually think that in America, in like Western countries, there's not that many people that are left out, right? In that, like, actually, if you look at credit conditions in the United States right now, like, they're pretty good. Like, most people who have pretty good credit are able to take out a loan. And so when I think about the people who are quote unquote left out, it's not necessarily people like you and me. It's not really kind of like your typical American that fits into that category. In my opinion, what I find to be a much more compelling and interesting subset of people that are kind of locked out of the current financial system, I think about the quote unquote unbanked. And estimates tend to vary as to like how many people in the world lack access to banking or traditional financial services. But some estimates have pegged it as high as 2 billion. Some are kind of sub 1 billion, but still in like the high hundreds of millions. But irrespective, like we're talking about a significant subset of the human population. And if you start to account for people who are, as we call them, underbanked, who are potentially have access to the financial system, but their only options are like extremely usurious or, like tend to like take advantage of them in various capacities, then that number grows significantly. So it's really these people that I think are an interesting kind of customer segment that doesn't necessarily have access to these wonderful new peer-to-peer lending sites, right? Because at the end of the day, if you're somebody who is in like a village in Africa or somebody who is in Nepal or what have you, like you may have a wonderful internet connection that allows you to go on YouTube and, learn everything you want on Khan Academy. But it's not like you can like have that same sort of borderless access to financial services because the underlying rails at the end of the day is paper loans and kind of like the traditional banking system, which has not evolved in the same way that the internet has. It's not evolved in this sort of kind of like open borderless manner. It's still kind of very much rooted in localized institutions and localized banking infrastructure.
Can you help me understand why someone in the United States would opt to use a platform like Prospera Lending Club or one of these gajillion things that exist out there versus going to their bank? Is it because the amount to be borrowed is just so small that it isn't worth going to a bank? I see why institutions would do this. I know a lot of people they like the hobbyist aspect of being involved with peer-to-peer lending, and it's a fun hobby for them. Why does a borrower choose something like Lending Club over other options that might exist?
I probably am going to be misrepresenting this a little bit because I don't work at these companies, so I can't tell you their exact customer profile. But through what I've understood, a lot of it is just like having like a web storefront for loans. Like that's just something that's like really nice, right? Like people like to access products through the web, it turns out. That has driven the creation of like thousands of companies and startups in the past couple of years. A lot of it is just like, I want to get a loan and I want to go online and do it. And I don't really care if there's like a peer on the other side who's like paying me to do that. And it's just a lot more practical than, walking into a bank branch. So I think that's a big component of it. There is also a certain component of it that is essentially that, certain people fall into a category where they don't necessarily have the best credit scores, right? Like they are a relatively uncreditworthy person. And this kind of creates a little bit of like an adverse selection effect where the sorts of people that are more likely to flock to these sorts of like alternative lending solutions may not necessarily be the best borrowers. And a great kind of example of how this can go awry is that in China right now, there's an enormous amount of peer-to-peer lending companies out there, many of which are like really, really sketchy operations. And they tend to attract like really, really bad and often fraudulent borrowers. And so it's not the rosiest picture ever, right? Like at the end of the day, at least in a country where there is a really strong financial system, if you already have good options at your hands, like you're going to take them and you don't really care about whether, you know, it's a big bank giving you that loan or somebody else. And so I think there's a little bit of a problem in that, like there's somewhat of an adverse selection effect often with many of these platforms.
Getting back to Dharma and the big opportunity that presented itself to you, it seems like there's a number of reasons for you to exist. One is that this open financial system that's being built right before our very eyes, starting with the birth of Bitcoin, really doesn't have a native way to lend and borrow money. And then there's the issue of the unbanked and the underbanked and generally the underserved people worldwide who don't have access to debt markets. Is there anything else that I'm missing?
Yeah, I think that there is something to be said about empowering entrepreneurs to start businesses in the world of finance by significantly lowering the barrier to entry to building a application that in some way involves lending. So like, you know, if you wanted to, let's just say, we'll go back to the kind of canonical guy in India example, right? If you are a person in India who has a great idea on how to originate and underwrite debt locally, and you know, you understand some subset of the credit market there in a way that nobody else does, you know who the good borrowers are, you know how to tell if they're good borrowers, et cetera. If you wanted to go and start a lending business, the first thing you got to go do is raise the requisite sort of debt vehicle. You've got to go door to door in Mumbai ostensibly and kind of talk to a lot of traditional debt investors and try to convince them that you're going to be good at that job. And that's obviously a very like onerous and bespoke process that kind of locks a lot of people out of that ability. And the beauty of systems like Bitcoin in general, and you know, I would argue this is kind of what we're trying to bring to lending markets with Dharma, is that like all of a sudden the barrier to entry is just like whether you can code. It's pretty much just a matter of like, can you log onto the internet and deploy this application? If so, then you have like native access to this infrastructure. And so similarly, like that's kind of what we're trying to do with Dharma, right? Like we want it to be the sort of thing where if you want to plug into this decentralized credit market and, you know, essentially start underwriting different loans and start putting loan offers onto the network, you can do that. All you need is essentially just like, you know, a couple lines of code and you need to like run a server basically, as opposed to having to go out and get like a banking license and go out and, you know, traipse around Mumbai or, you know, Manhattan or whatever to raise the necessary money. So I think there's something exciting about the idea. I think that lowering the barrier to entry to entrepreneurs who want to start financial services businesses fundamentally creates more competition for those businesses, which means that the prices of those businesses go down and the quality generally tends to go up. So I think that in a second order effect means that the consumer ends up getting something better.
So this isn't just about creating a decentralized, tokenized version of Lending Club. This is about creating a platform on top of which permissionless innovation can happen around loans and these kinds of debt markets. Is that fair?
That's a great characterization, yeah.
Okay, so that concludes Chapter 1. Let's move along to Chapter 2, which is an exploration of the blockchain technologies upon which Dharma and programmable tokenized debt and peer-to-peer lending stand. In this chapter, we're trying to understand the technology stack that paved the way for the Dharma protocol. Nadav, can you describe for us the crypto asset projects that have set the foundation for Dharma?
The first thing to talk about in any case, which I'm sure many of your listeners are very familiar with, is Bitcoin, right? And what was really cool about Bitcoin that kind of changed the whole game of what you could build in terms of financial applications is that all of a sudden you had payments as like a native programmable primitive that were totally borderless, right? And so all of a sudden it was like, if you wanted to build an application that anybody in the world could use that in some way accepted payments, like you could very easily whip that up by plugging into like a Bitcoin node. So that was a really radical concept. And obviously that kind of spurred the development of the crypto space as we know today. But I think that the big thing that kind of changed everything was when Ethereum came around. And mind you, this is when I started getting much more passionate about the crypto space, in that like all of a sudden you had this sort of general computing platform where you didn't have to like go and deploy an entire blockchain for every specific potential use case of blockchain tech. You could just write applications in like a programming language that looked a lot like JavaScript and basically deploy them onto the Ethereum blockchain. And so the way in which that kind of plays into what Dharma does and why we needed this sort of functionality is that essentially for a loan to exist, like what is a loan at the end of the day, right? It's basically just like, it's like a social contract between two people that says like, I am going to lend you this much money and you're going to owe me like that much money at the end of like a certain time period. And the purpose of that little social contract is to go out and basically make it so that if the person doesn't end up paying you back, that you have some sort of social proof that you guys agreed on this thing. And then you can take that social proof and, show it to a judge and they're going to go and like whack the person on the head or, more realistically, they're going to go and seize on their property.
Okay, time out. I'm going to do some native advertising for the Nomics API. This episode of Flippening is sponsored by the Nomics API. The Nomics API offers squeaky clean and normalized primary source trade data offered through fast and modern endpoints. Instead of having to integrate with a bunch of exchange APIs of varying quality, you can get everything through one screaming fast fire hose. If you found that you or your developers have to spend too much time cleaning up and maintaining datasets instead of identifying opportunities, or if you're tired of interpolated data and want raw primary source trades delivered simply and consistently with top-notch support and SLAs, then check us out at nomics.com. Okay, back to the show.
Essentially, what Ethereum enabled us to do that we couldn't necessarily do with Bitcoin is to kind of programmatically encode these agreements between two different parties, and also to like programmatically encode the sort of punitive actions that would take place if a borrower fails to repay. The best example of that in Dharma today is that, most of the loans that are issued via Dharma protocol are collateralized, meaning that essentially like if Alice and Bob want to engage in a debt transaction, Alice promises to put up, a certain amount of a certain asset as collateral in order to receive some other asset. They engage in that debt agreement. And for the duration of their loan, the kind of smart contract that represents that loan actually acts as the custodian of the collateral. It actually like holds on to the collateral on Alice's behalf. And so essentially the reason why something like an Ethereum becomes relevant here is because you need this sort of like kind of dynamic programmable functionality where a contract can keep track of like complex terms like, has this person actually paid back according to the schedule that they promised? Has this person actually put up the collateral that we asked them to, et cetera, which were things that were highly non-trivial and not necessarily possible with Bitcoin, which had like a fairly simplistic and primitive scripting language.
Thinking about some of these security tokenization platforms like Harbor and Polymath that exist that are built on top of Ethereum, you can imagine a scenario where someone issues several tokens that represent ownership in their home. In that future scenario that doesn't quite exist yet, they would be able to collateralize a loan with tokens that represent ownership of the home. There's, of course, complications around what happens if there's a default and can you actually possess someone's house with these tokens. But I think that gets to the idea around the future that could exist here. Is that the way that Dharma essentially works? Does every loan have to have collateral that underpins the value of the loan, or are there ways to do credit scoring and take a look at people's history and track record and make assessments about whether or not someone's worthy of that loan without collateralization?
First of all, the way that we've built Dharma is that it's like a super generic mechanism for issuing debt, right? So there's pretty much like almost no hard and fast requirements for what needs to happen when a loan takes place. So you could have a, on-chain collateralized loan, or you could have an entirely uncollateralized loan where, like the two parties just happen to know each other and like there's, a social reason to repay. So first point is that like we built this in a generic way on purpose so that like you could basically have this kind of unified credit market for an entirely diverse set of loan types. Now, with respect to kind of like your question about are most loans collateralized or are all loan collateralized, or are there ways in which you can have loans that are uncollateralized that have some sort of credit scoring attached to them, et cetera. Essentially, our approach has been to focus first on collateralized loans, insofar as like there is a demand for those right now from essentially speculative borrowers, people who want to like either short things or leverage things or take on some sort of margin. And it is possible today to do unsecured lending in Dharma. We have a mechanism that we call like the underwriter mechanism, where essentially you can have a third party underwriter come in and effectively kind of co-sign on the borrower's behalf their creditworthiness in the lending agreement as a guarantor of that lending agreement. But we also kind of underline that this is like a experimental feature set and not necessarily something that we think is going to be like the primary driver of liquidity in Dharma for a while. The reason being that it's just like underwriting and reputation systems are very complex, especially in a highly adversarial environment like the crypto community. So while we think this is possible, this isn't necessarily something that we are like putting all of our energy into encouraging people to do right now.
So let's close out Chapter 2 and transition to Chapter 3. In Chapter 3, we explore how the Dharma protocol works and the first-class operators within the system. Nadav, when I think of traditional debt markets and loans, I think of a lender and a borrower first and foremost. I also think about identity systems, underwriters, and credit checking systems. At a high level, who are the first-class operators working within the Dharma protocol?
And I think like the way that you phrased it is actually a great phraseology, like that there are kind of these enshrined first-class operators. So basically there are, besides the borrower and the lender, which are pretty straightforward to understand, there are two important actors to be aware of in the system. The first is what we call a relayer. Now, for those of you who were in the audience who may be familiar with what's called the 0x protocol, it's kind of gained a lot of attention recently. This is a highly analogous concept. So basically what a relayer is some sort of centralized entity that hosts a public order book where people can post requests for loans and where others can kind of see those requests and fill those requests by becoming lenders. And the relayer's incentive to do this is that the protocol has a built-in way of compensating the relayer with a fee when an order that was listed on their order book is filled by a creditor. So essentially, the idea is that this is basically like a super light way of spinning up a peer-to-peer marketplace business using just like open source code and without having to have like a bank account even really. All you have to do is host a server with one of these order books and people can go and post orders onto there and get matched with other lenders and borrowers. That's the role of what a relayer plays. And essentially, these relayers are kind of like the primary drivers of liquidity. And so we've already seen two different relayers come to mainnet in the 2 months that we've been live, but there are many others that we're aware of in the pipeline. And if anybody in the audience is listening who thinks that this might be an appealing business for them to start exploring, then by all means reach out to us. Now, the second set of first-party actors that are important to talk about are, the underwriters that I sort of touched on earlier. And basically what underwriters do in Dharma is not necessarily any different than what underwriters do in the traditional financial system. Basically, an underwriter in Dharma takes a loan request from a borrower and makes an assessment of that borrower's creditworthiness in the context of that loan. They basically make a prediction of like, how likely do I think it is that this loan request will be eventually defaulted on? And the idea is that like they have to kind of like co-sign onto the loan now. They now have to say that like, I, underwriter X, believe that loan Y has a, 2% chance of defaulting. And crucially, when the loan is actually filled, not only do they get paid some sort of like pre-specified fee, but that prediction also gets immutably engraved into the blockchain. And this creates this interesting sort of incentive system, right? Where if a underwriter is doing a particularly terrible job of underwriting loans, that's plainly visible in the blockchain because you'll be able to see that all of the historical loans that they've attested to did not end up turning out well or did not end up turning out how they had kind of predicted. Whereas the opposite is also true, right? Like if a underwriter is doing a particularly good job of underwriting different loans, then the empirical performance of their loan scoring should be evident as well.
So both the underwriter and the borrower are potentially accumulating reputation within the system over time. Is that correct?
I wouldn't go so far as to say that there's like any sort of formalized reputation system here, but at the very least, the underwriter is to some degree. This isn't like a end-to-end trustless mechanism. Like there is, at the end of the day, you do need to place some degree of trust in the underwriter. But we would argue that this is kind of better than the status quo insofar as, like if you are investing in loans that a certain online lending website has originated and underwritten, you're kind of taking them at their word that the default rates that they've told you about are truly accurate and that like their books aren't fraudulent and that they have like some degree of strong historical performance. Whereas in Dharma, the underwriters, which are functionally kind of performing the same role as one of these online lending websites, right? Like they're basically originating the loan and credit scoring the borrower and credit scoring his likelihood of default. There's actually an empirical signal that you can see that shows you how the cash flows actually panned out in comparison to loans they've underwritten in the past.
In many traditional lending scenarios, the lender is also the underwriter. Is it fair to say that in this sort of system that you proposed, the lending function and the underwriting function can be but don't have to be unbundled?
Yeah, that's entirely accurate. Yeah, I think that's like part of our kind of core thesis is basically taking what used to be kind of like inexorably wedged together in the lending process and kind of like stripping it into its component pieces. You don't have to do all these things separately, but if you want to be an underwriter and an underwriter only, or if you want to be a lender and a lender only, you can do that.
I think a lot of our listeners probably understand exchanges and cryptocurrency exchanges, at least at a surface level, better than they understand debt systems. It sounds like there's definitely an analogy here to an exchange. You've got the maker and there's the taker, which is like the lender and the borrower. You've got an order book that's provided by the relayer, and then you've got some kind of transaction fee, which is interest on the loan. This is basically, I hope this isn't offensive to say that this in a lot of ways sounds like 0x for debt scenarios.
That's not offensive. I often characterize Dharma like that, like as 0x for loans. Like it kind of is that, right? Like at the end of the day, because it's basically like what a loan is basically like the borrower selling a debt asset to someone. Like, I'm going to sell you the rights to these future cash flows at the price that is the current principal of the loan. So it is basically a maker and taker arrangement. Just the crucial things that need to be layered on top of it is like, okay, well, how's the taker going to have any idea of what how to price this thing in general? And so like there needs to be some sort of like underwriting mechanism or some sort of guarantees about the repayments to happen. And two, just like one thing that is not possible in 0x, which is inherently why we need like an entire new set of infrastructure to do this with Dharma, is that you can't post orders for assets that like don't exist yet. And in the case of Dharma, like that's basically like what it is, right? You're posting an order saying like, if you agree to this, I'm going to create a debt token and sell it to you for the price of the principal. That's essentially the missing layer there.
We're going to cut this conversation off right here. This concludes part 1 of this deep dive on tokenized programmable debt. Part 2 is just as long as today's episode and just as good, perhaps even better. In part 2, we complete chapter 3, then start and conclude chapters 4 and 5, which are about the top use cases and investment opportunities for tokenized debt and Dharma as a corporate identity, respectively. It's a fascinating conversation and a respectable conclusion to this deep dive on tokenized debt. And as a reminder, if you want to discuss any of this, you can join us on our Telegram group at nomicstelegram.com. See you next week. That's it for this week. To sign up for our free crypto investing newsletter, listen to other episodes, or get the show notes from this episode, please visit flippening.com. I also invite you to check out the startup that funds this podcast, Nomics, spelled Nomics, at nomics.com. Finally, if you got value from the show, the biggest thing you can do to help us out is to leave a 5-star review with some comments and feedback on iTunes, Stitcher, or wherever you listen to podcasts. Thanks for listening, and see you next week.